Welcome back to Market on Close. Let's go from the macro into some stock picking with Matt Fleming joining us from William Blair, co-portfolio manager, small and mid-cap value strategy. Matt, thanks for joining us this afternoon. Good to have you on the show.
Thanks so much for having me, Oliver. I really appreciate the time today.
Absolutely. Love that Chicago background. Hey, let's first start with kind of the big picture item as we were just discussing the difficulty of picking stocks outside the mega cap realm. Actually, a leftover chart from our last discussion from Jack I'm going to pull up right now that basically shows this massive, very linear relationship between performance on the year in terms of just return and then the actual size of the company. Basically, bottom left to top right, the smallest companies in the worst quintile here. So, I mean, how tough is the job right now?
Well, it's not for the faint of heart, that's for sure. I think what we've found is that, when times like this, we really have to stick to our knitting, finding high quality companies that we think are trading at overly discounted discounts to the market. Said another way, we're looking for companies that are, trading below or at the levels of inferior peers, higher quality companies, the proverbial babies that are thrown out with the bathwater. So for sure, it can be difficult and you can't time it, but the trick is really to stick to your knitting, stick to your process, and really continue to look, because if you look hard enough, you'll always find great opportunities.
Are there specific characteristics that are like at the top level of filtering and of sorting for companies? Something quality oriented, I would guess.
Absolutely. So we're looking for two things. One is quality, which we define as very high quality companies as evidenced by high returns on capital, returns on equity, strong margins, strong sales growth on the organic level through volume and pricing, as well as a good balance sheet as defined by low debt to equity ratios. So we're looking for those. And then a key metric that we look for is cash flow generation. We really think cash flow is the ultimate arbiter of a good company that, obviously brings into what the company has to do to invest on the balance sheet and through CapEx, but also really plays through their ability to perform year in and year out. So those are really what we're looking for. And then, as I mentioned, what we're looking for really is those high quality companies that are trading at a discount to their historical valuations. We think that's a really indicative metric to find good opportunities in the market.
Okay. Two themes that I think are pretty interesting. You describe misplaced cyclicals and then sort of false herring, artificially intelligence disrupted companies. Let's go to the first one
Sure.
real quickly in the cyclicals, the misplaced cyclicals. That includes J.B. Hunt is one of them. What does that mean?
Yeah, so J.B. Hunt's one of our favorites. This is a new addition. We've owned this name in the past. J.B. Hunt is one of the premier intermodal providers of transportation. They will take boxes at the point of entry in the port. They will move it and put it onto a train car and move it long distances that are much longer than a typical truckload over the road length of haul. They've incorporated a number of different transportation services as well. So again, they are the industry leader. They've got industry leading contracts with the Burlington Northern Railroad. So really just differentiated, very high return on capital, 25% ROE, and yet the stock is trading at the low end of its 10-year historical range. Call it about a 19 PE versus the low of 17.5 and a 25. So there's plenty of upside in the multiple, and we think that there's plenty of upside, obviously, in the fundamentals at this point. Transportation, as you may be aware, is really struggling pretty mightily. There's just an oversupply of capacity, and at the same time, we've seen retailers pull back on their inventory. So demand is pretty low as well. This is unsustainable in the long term for particularly the smaller trucking companies. In some cases, they're operating 20% below their costs. So every time they leave the driveway, they're losing 20%. So that's just not sustainable. And we think over time, you're going to see the market really balance in terms of supply and demand. And then as far as the stocks go, we understand it's very difficult out there, but as I mentioned, we look at this stock and think that the market is putting a trough multiple on trough earnings. So you really have two ways for the stock to perform, re-rate back to historical multiples, as well as see improving earnings, which we're starting to see at this point as well.
Okay, nice. All right, so misplaced and mispriced. Perhaps also Hillenbrand, another one that's just gotten cream that fits in that category. Yep. But let's talk about the stocks that folks think are getting AI disrupted, but you would argue are not. One of them is sort of an automation based company, which I think is kind of an interesting approach. Variant, which, I mean,
Yes.
on the surface, it does kind of seem like, there's areas here that could be displaced because of AI.
For sure, Oliver. So Verint is a industry-leading consumer engagement software. So think chat box, think script for call centers. A very integral part of companies really streamlining their customer engagement process. And right now, the narrative is that AI is going to disrupt their services, when in fact they are actually a consumer of AI. And so, really, 2 points here. One is that something like 20% of all engagements cannot be solved on an automated basis. It's something unusual. Think how many times you've pressed zero when you're trying to, engage with an actual person. Because the automated software really is not going to get the job done for you. So we think, first of all, there are scenarios where AI is not going to be able to disrupt the software. And secondly, again, as I said, they are actually a consumer of this product, which only enhances their productivity. So I think the market really has come around to understand this. It was last year really kind of as the AI craze took off. I think it was shoot first, aim later. But again, the market is really starting to piece through, some of the wreckage and finding some really good opportunities where it could actually be ultimately somewhat of a beneficiary from AI.
Wow, cool. All right, nice. Love the picks, love the details. Thanks, Matt. Good stuff.
Great. Thanks for your time. I really appreciate today.
Yeah, all right. I always love a deep dive in a case well made. Matt Fleming, small mid-cap value strategy at William Blair. All right.